Private credit has now entered stage 2 of 3, the forced selling stage. This $1.8 trillion private credit crisis will impact you even if you are not directly invested in it, because of the likely collateral damage to banks, pension funds, the broad economy, and the stock market when panic sets in. Next, I will give you some important updates about the stock market. This will include a major warning indicator flashing 6 times this month, a level last seen in February 2020, and data showing how insiders are buying extremely expensive insurance against a near-term market crash. Welcome back to the channel. I'm Nico the Bony. Let's get started. Let's start with the 3 stages of a credit crisis. Stage 1 here in yellow, this was basically the past 2 years. We saw a few concerning issues, including funds that were supposed to be very safe, but they were contained. Stage 2 is what we just entered. This is where we are once you start seeing forced selling under distress. And this started with Blue Owl last week. It was very publicized this time, so not contained. Many people have started talking about it. And we saw Contagion across other as well. I'll show you a chart. Stage 3 in red here is when the panic sets in. And usually this affects all assets because once the confidence drops, it spreads very rapidly. The stage 2 can last, days, weeks, months, even potentially a year or two, but it can also be very short, especially nowadays that people can basically do a bank run from their phone very quickly and information spreads on social media. So don't think that just because in 2007, 2008, it took a long time to go from Bear Stearns to Lehman Brothers, this time it could take only a few days or a few weeks if things really get out of hand. So Blue Owl Capital is the fund that was in trouble. It's a major alternative asset manager, and they've been in trouble for months. As you can see here, it's 3 of the tickers you can follow on the stock market for them. But basically, they've been in trouble since October, and they have a lot of investments related to AI, which is why it's also potentially a domino that could contribute to bursting the AI bubble. And basically, last week, they came out with a news saying that they permanently halted redemption for a $1.7 billion private credit fund that was aimed at retail investors. And this came very quickly after last fall, they tried to merge it with another fund to prevent the quarterly redemption, because the fund they created, it was a really bad idea from the start. Basically, they didn't align the quarterly redemption with the asset inside the fund. And so it was doomed from the start, basically. But what came next actually was a PR spin. So the next day, on February 19th, they came out with this tweet where they basically said that, oh no, people are wrong. They don't understand. We are not halting liquidity. We are accelerating the return of capital. But come on, this is like PR spin because they don't give a choice to people. So basically, the fund will become a fund that will just be closed over time. So there is no more money coming in. People don't have a choice. The fund will be liquidated over time, but they don't choose when or how much they will get for each year where they will have potentially to pay taxes. And this is the kind of thing that can take years based on the past. So this is really a bad news, but they're spinning it as a good news and pretending that everything is fine. Something else that they did recently was they published something in the past 2 months saying, oh, we have 2.7 billion of cash available, so there is no problem. And you can see how somehow they need to halt redemptions very shortly after. So something happened. Either they didn't have really the cash, it was maybe a short-term loan, or all the cash was gone because more people than they thought wanted their money back. But something else also that they spin here was that they sold for $1.4 million of assets, and they claimed that it was sold near 100% of par, which is like the initial amount they paid for it. The problem here is that they didn't provide any details. It wasn't transparent at all. And usually what happens in these situations is that they will sell their best asset first to show to people, you don't need to panic, we can sell things and we get the money back, no worries. But most people who really know this better than me are saying that the rest of the assets are probably toxic waste. So in other words, really bad things that they will be, either it will take a really long time to sell it or they will have to sell it under distress, basically. So it's a really bad news for investor of this fund, investor of private credit and private equity, because usually it's the same type of fund that do both. And here is a quick chart to show you basically what we can see for banks, although it's only the visible part of the iceberg, but we don't see for private credit or equity because it's very opaque and it's not transparent. Here you can see that banks are sitting on a lot of unrealized losses since 2022 because they bought a lot of bonds when the interest rates were low, and then those bonds lost value when the interest went up after 2022 when the central banks raised the rates. But at least here you can see the difference between the two different colors, so the blue and the blue/gold areas. And basically, the blue ones are the ones that are basically, they don't lose the money here if it's held until maturity. Basically, if there's not a bank run of people asking for their money back, they can hold the bond until the expiration date, and then they get 100% of the money they put into it. But if they are forced to sell it, then, they're in trouble. And so in theory, it could be the whole thing. So both colors combined could be the loss of the banks if everybody asks for their money back right now. But, this is the kind of issue we don't see in the murky private credit and private equity market. And here is a chart to show you the contagion I was talking about before. So you can see it's not just Blue Owl Capital, it's all these other well-known funds that are big in the space of private credit and private equity. And well, they've been falling since the beginning of the year, but you can see how on that day of the announcement for Blue Owl, they all dropped a lot in just the one day. And so it shows you how the contagion can spread. And some experts are comparing what just happened to what happened in 2007 when BNP Paribas, French bank, froze funds due to evaporating liquidity. There was also Bear Stearns in 2007 as well. So those were some of the dominoes that led to the 2008 global financial crisis, that led to the Lehman Brothers, despite the banks and governments saying everything was under control. By the way, in 2023, when all the banks in the US were going bankrupt, as a reminder, one of the banks that went bankrupt a week before, it was audited by the Fed and said, they said that basically everything is fine. So how can you have the Fed audit a bank, say everything is fine, and a week later they go bankrupt? That shows you how much we can't rely on the assessment of the Fed and credit rating agencies, just like in 2008 when, basically they said that everything was fine when it was like pure garbage. Something else that's interesting is that even the Fed, in the minutes from their last meeting, are actually saying that they are worried about the private credit and private equity. So you can see how, usually they don't talk about this because they're like cheerleaders for the economy. So when they actually raise that, they are not just worried about the risk of the private credit sector, but how it could spread to other sectors, including insurance companies and banks and non-banks. That shows you how the problem is no longer contained and has spread, and that's why the risk of contagion increases, and that's why we could potentially see a rapid shift from stage 2 to stage 3. So we'll see how it goes, but something worth monitoring. And something else that happened last week that could be related, we don't know exactly because they're kept secret, but at least we can see that there was a use of the Fed's repo operation for emergency lending. And so just 2 days before Blue Owl does the announcement, somehow there was a need for $30 billion of short-term funding because the plumbing of the financial system couldn't handle it. And this is the fourth largest since the COVID crash. So you can see how things are, when you put all those things together, you can see that there are really big cracks in the plumbing of the financial systems. And it's important to pay attention to not be caught by surprise. So if you want to keep this on your radar, of course, you can subscribe to the channel, but I recommend subscribing to the free mailing list because I don't always have the time to do a video. And so at least I'll be able to keep you in the loop. Like I sent an email about this a week ago to my list. The link will be in the description below. So now let's look at the stock market. Of course, Nvidia will release the earnings soon. But the most important will be what they say about it, like the narrative, the forward guidance, and what people find by looking into the details. But this is not new. Especially if you saw my last video, what is important to remember right now is that the stock market will have a really big wall to go over, and it cannot really go over that wall without tech participation because tech has been basically oversold in the past few weeks, and the rest of the market has been basically overbought. And so right now, all the sectors that are overbought are likely to mean revert. But if tech doesn't participate to hold the stock market or potentially to do a bit of a rally, the stock market could really roll over hard. So we'll see how it goes. But this is definitely something to monitor over the next few weeks. This chart is interesting because we can see that retail investors have poured a record $48 billion into the US equities in the last 21 days. And that's while the smart money has been doing the opposite. So basically getting rid of a lot of stocks and placing very unusual bets and expensive bets that are basically going to pay off if there's a major shock coming. So I'll show you a few charts. So here is just quickly the VIX for those who are interested. It's the fear index basically. And look at that expiration date. People are betting that the VIX before May 19th will go over the 70 strike. And just to give you an idea of how rare this is, this only happened twice in the whole history of the VIX since 1990. This was in 2020 and 2008. So people who are betting $1.2 million on this, not a small amount, are really betting for like a major shock to the market before May 19th. That should tell you something about how they are seeing things or what information they have. Another one, this is for the ETF for the Nasdaq, so QQQ. And look at that, it's even closer. They are betting that before April 2nd, the Nasdaq will go below 545. And the lower it goes, the more money they will make. So that's another big bet. And they did the same thing. Well, not necessarily the same person, but another big bet was placed on the IWM ETF, which is for the Russell 2000. Same date and going below 235 within the next 37 days. So it shows you how they are really, betting on something major happening, because those insurance are really expensive to buy if you're wrong, because they will go to zero very quickly. And there's also another way to bet against the market in a way. So you can bet against the Nasdaq or the Russell going down or gold going up. And this is actually my next one. This one shows you on the future contracts that some people are betting that gold will basically go up to $20,000, so basically 4x what it is right now, before the end of the year. So of course, they could make money along the way, but the max gain here would be if gold reached 20,000. So this tells me, and the estimate amount was 55 million placed on these bets. And this tells me that either they have a lot of money to burn, or they are insider and they know something that we don't, like potentially that the US is about to reevaluate gold, because right now it's valued as like $42 per ounce, which is ridiculous. So if they decide all of a sudden to reevaluate, that could have a major impact on the price of gold, and this contract could be worth hundreds of millions or more, or potentially billions if it turns out to be revalued higher. So something worth paying attention. Like when people start betting on things like this with a lot of money, that tells me that usually some people know something we don't, and oftentimes it's insiders who are close to the government or entities who know something big is about to happen. So this is not worth copying, but worth monitoring, because this could be a major year for gold if this happened. Plus, imagine also what kind of environment would be in theory with gold at 20,000. What would the stock market look like? What would the economy look like? What would the geopolitics look like? So this is not necessarily good news if gold is at 20,000 before the end of the year. And lastly, because I have too many charts, so I can't show you them all, but this was interesting. I've talked about it in the previous videos as well. The Hindenburg Omen is a warning signal, and this signal has been ringing 6 times in the past 6 months. And as you can see, the last time this happened was just before the 2020 crash, and in other instances where the market, at least at the pullback, small to medium, but basically this is an indicator that something not right is happening below the surface, and it's worth paying attention. And finally, I want to help you better understand my 3 scenarios for the SP 500, but includes the Nasdaq a little bit as well, over the next few weeks and months, because in the last video, I kind of tried to combine 3 scenarios into one chart. I thought this was potentially make it simpler, but based on the comments and the question I got, I think it would be worth it to show you very quickly the 3 scenarios with 3 different charts. So that's what I will be doing right now. All right, so let's start with the best case scenario. So here you can see that, it's 5% chance, but if it happens, it will just be a shallow pullback up to about 613 on the SPY ETF for the SP 500, which is basically the top of the at the end of 2024, early 2025, and then it would took off again. I think it's very unlikely for so many reasons, but right now I just want to give you a brief overview. If you want more details, let me know in the comments. Now let's look at the best case. So this is what I think has 80% chance of happening. So basically we are looking at a significant drop in the yellow box here, which is between 570 and 480. And so that's a drop of 18 to 31% from the all-time high, the current all-time high, of course. And then it would bounce and it would go back up between 700 and 1,000, so still on the SPY ETF. And here's the worst case scenario. So this is a 15% probability. I'm looking at the very long-term trend that started in 1932 after the 1929 crash. And basically, it would mean that we are in the last wave of the last wave of the last wave, basically, of what we typically see. And so here, I have a yellow box, an orange box, and a red box. And so basically from the top to the bottom, it would be between minus 38% to minus 88%, depending on what happens. This is if there's a flash crash, because something else that could happen that would actually be worse is if it drags out over years or decades. Like, for example, Japan, that took 35 years just to go back to even, and that's before inflation. And so sometimes when government or central banks intervene, it looks like they are solving a problem, but really they are creating 10 problems down the line, and they are really making it harder, and they are letting the zombie companies survive, and they are distorting markets and incentives and all that. So usually it makes things worse. Something else that could happen as well is a melt up. This is basically what happened in Turkey when the currency was being devalued very rapidly. So if you look at the stock market, it looks like it's going up, but it's actually the worst of both worlds because your money is losing purchasing power every day, but yet you have to pay taxes on those gains, that nominal gains that are based on the stock market performance. So this is, the two potential things to keep in mind in terms of what could be happening and how it could be happening, depending on the type of interventions we will likely see. Because of course, if the stock market drop like this, I don't see the Fed and the government doing nothing about it. But what will they do and how they will do it and how will people react to it? This will, be the ultimate thing to understand to react to this potential crisis, basically. If you want to be prepared for what comes next, make sure to subscribe to both my YouTube channel and my free mailing list. I'll see you in the next video.